We've got two of the senior executives from the Green Deal Finance Company with us. We've got Mark Bayley, CBE, and Allison, not Peter, Petter, because he comes from Norway, I understand. Mark was Chief Exec of London and Continental Railways from April 2009 to March 2011, and developed the High Speed 1 rail project, and was the owner of the UK arm of Eurostar, which is fascinating stuff. So big infrastructure there. And it was for that he was awarded the CBE, so he obviously played a pretty important role. Allison is Commercial Director of Green Deal Finance Company, wealth of experience in the energy sector, 22 years in the energy business, and a number of senior positions in Centrica British Gas, and a range of other companies. So, without more ado, we're going to get on. They're going to share this presentation between us, and then I'll get up and facilitate some questions. So, welcome, and thank you very much for coming.
Well, thank you. I'm absolutely delighted to be here, having spent 13 years on the project down the road, High Speed 1 and St Pancras, and indeed Eurostar. And perhaps we can explore it in questions, but there are so many analogies about a major infrastructure program being launched, so big that nobody quite knows where it's going to end up, except the route, of course, and accompanied by forecasts which don't necessarily turn out to be the case. All that deja vu has come through in my experience over the last few years in the Green Deal, which I'd like to talk to you about. Because I'd like it's a public seminar, I'd like everybody to be on the same page, and so what I'll do is begin by introducing the Green Deal and the Green Deal Finance Company briefly, before talking about the financing of the Green Deal, and I can take questions about the financing of the company in questions. Then Petter will follow by talking about the actual progress over the last 2 years since launch, the Green Deal in practice. Now, as this is a public seminar, this is a presentation to inform a public debate, academic debate about the Green Deal and energy efficiency. It is not an exercise to market or sell Green Deal plan finance to you. It is not an exercise to advertise securities in the company. So if any of you feel remotely tempted to take out a Green Deal plan or buy securities in the company, could you leave the room very quickly? And that keeps us clean from all the compliance issues you might otherwise encounter. But introducing the Green Deal, it's a government programme to improve the energy efficiency of the UK's housing stock and to reduce household carbon emissions. The Green Deal plan itself, which is at the heart of the Green Deal, is a credit agreement, very similar to a loan, in which householders can borrow money to pay for the cost of installing energy efficiency measures in their household, and then very importantly, after borrowing, repay the borrowings as part of their electricity bills. And it's often referred to as a pay-as-you-save scheme, in that the upfront cost of implementing the energy efficiency measures is financed out of the energy savings that result. And it's really the Green Deal is what you might call the brand. The pay-as-you-save, or rather the repay-as-you-save, is the actual principle behind the whole Green Deal. Now, a key feature of a Green Deal plan is that it remains attached to a property's electricity meter, and the repayments are the obligation of whoever is the bill payer at any point in time. And if the individual who pays the electricity moves out of the property, the Green Deal plan remains behind, attached to the meter. It is the only loan you can literally walk out of, leaving it behind for the next bill payer. And that is at the heart of the finance and heart of how we can use that mechanism to develop the finance that we have. And the energy savings, which are designed to repay the Green Deal plan repayments, are calculated according to a methodology which is set independently of us, independently of government, and used to determine the amount that can be borrowed in what is called the golden rule, that the expected level of savings, or rather the repayments on a Green Deal plan, may not exceed the expected level of savings. from the energy efficiency measures that are being installed. And I emphasise expected. It is not a guarantee, it is an expectation, but it is set independently. Now, turning to the Green Deal Finance Company, we're a not-for-profit company set up by industry participants, major energy suppliers, for example, and other stakeholders in the Green Deal and in energy efficiency. And its role is to set up, finance, and administer Green Deal plans in the Green Deal Plan programme. We were incorporated just 3 years ago almost. I became chief executive in October 2012 with the role to get the company financed and operational, and we achieved that in April 2 years ago. So that means we're just about to complete the first 2 years of operation. So really it is a very young company, still very much in the development phase. But in that development phase, what have we achieved? Well, we've implemented a national pay-as-you-say scheme infrastructure across the country with over 10,000 plans populated across the country, as you can see. And that really represents lending money under Green Deal plans, but very importantly, we've also been able to collect repayments from electricity meters, and I'll come to that because that's also terribly important. The company itself is a small but committed team of 16 people, I was saying earlier, that a quarter of the company are here this evening, and we do not deal with consumers, and we may not, under compliance rules, market or sell Green Deal finance to them, hence the health warning at the beginning of the presentation. And what the company does is finances plans, Green Deal plans, sold to consumers by Green Deal providers. Green Deal providers are really the contractors that householders would employ to install energy-saving measures, be that insulation, solar PV, condensing boilers, or more esoteric devices, heat pumps, and so on. Not that heat pumps are anyway esoteric. The list goes on. In fact, there are some 45 Green Deal measures that can be installed under the programme, and some of them are really quite esoteric. But some of them are really developing, and it's very exciting as to what can be done. So the Green Deal provider will sell the plan to a householder in order to finance the works that the provider will then set out to do. And what we do is then finance plans, of course, and then administer the plans over their term, which is essentially about issuing annual statements and statements on request and so on, and dealing with handling arrears. But let's move to the wider context. What I'd like to do is to actually sort of explain what the Green Deal is really doing. And as we all know, UK housing stock is notoriously energy inefficient, and it also accounts for about a quarter of the UK's carbon emissions. And therefore, any strategy to reduce carbon emissions has to involve household energy efficiency. But the problem is that the do-nothing reduction in household energy efficiency over the next 8 years, really as a result of rules coming in on appliance energy efficiency, vacuum cleaners and kettles and so on and so on, it leads to about a 2.3% reduction. But the UK's target, the government's target, is about 8%, which is 3.5 times increase over the do-nothing. And there are really major challenges to move the reduction from 2.3% to 8%. And the first challenge in household energy efficiency is that measures that are installed have a very, very long payback period. And the second challenge is that to do it all by subsidy is simply not an affordable option, nice though that would be. And apart from the fuel poor, who for social reasons should be receiving subsidy for energy efficiency to make their homes warmer at no cost to them, for the large majority of the population, 100% subsidy is inequitable, because householders will receive the measures for free, but benefit from all the energy savings for which they've made no contribution. And the motives underlying the Green Deal are really to turn that on its head and maximise the amount that householders can contribute to energy efficiency measures in proportion to the energy savings that they generate. And that has the effect of reducing the balance of subsidy that is needed to achieve those carbon reduction targets. So what the Green Deal and the Green Deal Finance Company are aimed at is the first objective of maximising householders' access to finance for energy efficiency measures, and then maximising the amount that they can borrow prudently against the energy savings that are generated. And we achieve this by addressing several market limitations or market failures. So let's look at those market limitations and how we've addressed them to finance the Green Deal. And there are really two market limitations to talk to you about. The first is that conventional sources of consumer finance offer fairly limited borrowing term, except at very high cost. So normally the range is about 2 to 5 years, but if you go out to 10 years, you're paying mid-teen APRs. And the second limitation is that low-cost unsecured credit is not widely available to consumers. So those are the challenges that we've addressed. And let's deal with the, I managed to turn it off then, but I got it back. And as I said, we'll deal first with the question of term and the fact that normal consumer finance is only available for 2 to 5 years. And the average cost of personal loans in the country for 5-year loans is 9.3%. And at that rate of interest, if you borrow if you have £100 annual savings for your energy efficiency measure that you might install, be it insulation or a condensing boiler or whatever, it can only repay a loan of £422 over 5 years. But if you could extend the term of the borrowing to 20 to 25 years, that £100 can do something really quite serious, which is to borrow £1,000, which is a lot more money that can go into buying the energy efficiency measure. And the Green Deal device is that by lending to the bill payer rather than the individual, we can rely on the strong propensity of whoever is living in a property and paying the electricity bill will continue to do so to keep the lights on for the long term. And that means that we can extend the term of the Green Deal plan towards the expected lifetime of the energy efficiency measure generating the saving. So if you look at the Green Deals that we've got, principal measures are up there: insulation, solar PV, condensing boiler, those are principal measures in our book at the moment. And we lend for insulation up to 25 years, solar PV 23 years, condensing boiler 12 years. And the annual savings you can see there, so that's a rating of £100 to £200. And the plans that we do typically, and these are approximate figures, will raise about 10 times the amount of the annual saving or thereabouts. But if you just went to the consumer finance market, the conventional consumer finance market, to get 5-year loans, you're only going to raise about half that amount. So this is how Green Deal plans deal with the lack of term in consumer finance. The next thing is to look at providing low-cost credit. And this rests on the fact, as shown in this graph, that electricity bill payers have substantially lower default rates and arrears experience to conventional consumer finance. This is the proportion of the bill unpaid, and you can see it decreases over the months after the bill is issued to about a default of between 3 and 4%, which is a default rate about 2 to 3 times better than normal consumer finance. And what that means is that, coupled with the fact that we're a not-for-profit, we don't pay dividends on shares to investors in the company, that plus this very strong covenant behind the repayment of the Green Deal plans means that we can offer Green Deal finance on the following rates, which are sort of unsubsidised, if you like. And the important thing about those rates and charges that we charge to set up the Green Deal plan and to administer the plan over the life of the plan is that they are fixed. They don't move up and down with interest rates, they're fixed for the term of the plan. And importantly, the same pricing is available to everyone who satisfies our credit criteria. And I'll come on to our credit criteria in a moment. And also I mentioned in passing there are no early repayment charges. Of course, this is not about advertising the merits of Green Deal finance, simply just pointing out features of the product in the market as it stands. Now, the interest rate and those charges convert into annualized percentage rate, the all-in cost of borrowing, if you like. And generally speaking, for most of our book, we're lending at single-digit APRs. And to take the average, typically we're lending a 3.5 grand Green Deal plan for a 17.5-year term with an APR of 8.3%. I very much doubt there's a plan with those fit characteristics, but that's the average on our book. And in comparison, as I said earlier, the average cost of unsecured bank finance to consumers is 9.3%. And the average cost of credit cards, and some people do pay by credit cards, is 17.5%. And in fact, if you are not a very good credit score, and you take a 10-year boiler finance plan out from a large boiler player in the market, you're going to pay an APR of about 19%. The thing about these averages, the 17.5 and the 9.3, they are averages, of course. A lot of people, half the people, are paying a lot more than the average. And that is a very important issue that we can address by having APRs on our finance, generally speaking, less than 10%. Now, travelling here on the tube, I saw a very attractive consumer finance for about 3 or 4%. And then I reminded myself that all those advertisements you see online or on the tube, or high street or whatever, for consumer finance, the rules are that those offers, those advertisements, those offers are only need to be available to just over half successful applicants. So you have to be a successful applicant in order to be eligible. And therein lies the fact that a lot of people are borrowing multiples of the advertised rates that you see. Obviously, mortgages offer much low-cost financing, generally a few points below our rates, and they offer, of course, the term, the long term. But to take out a mortgage for an increased mortgage for 3.5 grand or whatever, you're generally speaking paying an arrangement fee. And we do find that mortgage finance is not always competitive against Green Deal plan finance, particularly in a sweet spot between 1,500 quid and 5,000 pounds. And there's some independent comment that you can look on the slides after from both the UK Green Building Council and Which, talking about the competitiveness of our rates. So this is how we've driven or generated low cost credit. The next thing is to talk about how we can make it widely available. And on the next slide, here we are. Right. What I've got here is a chart of credit scores and the UK population. So credit score of 0, you can't borrow a penny, and a credit score of over €1,000 prime credit, and you can see the default rate goes down, and then suddenly at a credit score of about 620, it spikes up. And what we have done is set our credit threshold at that 620 level just before the point at which the default rate begins to rise significantly for lower credit scores. And that captures, in terms of credit score eligibility, just over 80% of the adult population. What's interesting about credit scores is that conventional credit is really only available on reasonable terms above a credit score of around 800. And just a reference, to get the headline terms that you see in the advertisements, you have to have a credit score probably over 1,000. Now this is very significant, because not only do we capture over 80% of the population subject to affordability tests, but also bearing in mind that normal consumer credit is only available to about half the population, and only a third of the population have mortgages, what we're able to do is capture about 25 to 30% of the population who couldn't otherwise borrow, and certainly couldn't borrow at rates less than 10% in order to finance energy efficiency measures in their homes. So it's very widely available and very inclusive, and we would regard it as very socially useful. And what is interesting is if you look at the book, this is a graph of the credit scores, percentage of plans with credit scores 620 to 700 around there are moving up. And what we're seeing is that just over a quarter of our plan applications have credit scores in that 620 to 800 bracket that I've been talking about. We couldn't otherwise get the money, and certainly not on the terms that we offer. And interestingly, about 20% actually are prime credits. So that does indicate that whatever is said in the controversy about Green Deal finance and interest rate, that actually it is competitive for prime borrowers too. And the final thing that I'd like to end on is the default experience. So the first rule, of lending money is not really how much interest you can get on lending the money, but actually getting your money back. And we've now got, with the first plans, repayment history setting in. And if you remember that chart I showed you of the arrears, the orange line, well, this blue line is the initial expectation of the arrears and default experience that we would expect. And this is the first time we've made this publicly available. You can see it's trending down here. Now, we're getting the first data in, and actually interrogating the supplier's billing systems to really track what the data is saying is a little difficult. And we're a bit glum at the black line there, because it was really above the blue line for some time, but it trended below, which is good. But there was one supplier where we're having problems in getting the data properly sorted out between the money being held in their supplier's billing systems versus being handed over to us, against a completely different problem of the customer not actually paying. When we took that outlier off the data, what we're seeing is a very, very encouraging arrears performance, that actually, in terms of arrears, we're ahead of initial expectations. That's early days, and we need this to prove over time. But if that sets in and that dashed line becomes the firm black line and stays there, that validates the whole Green Deal finance concept, and that's terribly important, and not least because it's going to be able to drive our ability to finance the growth of the programme in the capital markets. So that's the finance, and I'm going to hand over to Petter to talk to you about how the Green Deal has been working in practice.
So that's the macro. This is more of a micro look. The aggregate demand picture. Mark's talked about how customer behaviour has underpinned affordability and our interest rates. I'm going to talk about how customer behaviour actually brings on the demand pictures that we're going to see, what do customers face in the home with the decision making, and how have we fared. So starting with the macro picture, we're building a new market, and going from planning into startup is not simple. The reality is we've been going for 2 years, and you'll see that a little bit later, but constant improvements are necessary. We've been changing our processes, we've been changing our product to an extent, we've been changing the way we communicate. There's a lot of iteration that goes on, and it takes time to get right. Big stuff happens, externalities. We've been blown off course a couple of times, we've come back onto course, but big changes require big reactions, and we'll come on to that. The supply chain is important. The Green Deal providers that Mark mentioned, the installers in the homes. But much more important are the customer economics. What's in it for me? And the interplay of incentives, of the Green Deal finance that Mark took you through, but also of customer willingness to install or even consider energy efficiency in the home. So here we are in the early days, and this is the days of moving in the very beginning from almost 2 decades of total subsidy into a mixed pay-as-you-save with subsidy, and to move the installers, who are predominantly blue-collar installation companies, into being FCA, Financial Conduct Authority, compliant lenders. And the first problem we saw was that our finance contracts were just far too complex. We expected the installers to come up with their own contracts. In the end, we had to shortcut this and provide our own templates for the installers. And the iteration thing, we're on version 4 now. But we simply could not have got volume by expecting installers to become FCA compliant and write their own contracts. The second thing is, it's an awful lot easier, having had 2 decades of practice, to administer a subsidy scheme, the cert and assess of the old and the eco of today, than it is to sell Green Deal finance and sell measures into the home. And lack of sales skills was important. And the third thing is, it's new. And it's not only new for customers, because there's virtually no advertising out there, but it's also new for the supply chain, and the supply chain lacked experience. So we're in a low growth mode, and the first contracts were in May, and we have Green Deal providers learning how to blend the ECO, the subsidy program, with Green Deal finance. And the scale on the left there are cumulative number of homes that are being done. And you can see that having started in May, we didn't really get that far. We're below 2,000 applications there. In December 2013, there was a sudden change to the ECO rules, black line. And at that point, subsidy, by and large, vanished from the market for a time. And what we saw from this is that the Green Deal providers effectively slowed and stopped. So you can see a rate of increase as we were learning. We were learning about how to blend ECO with Green Deal. The black line comes in. The only guys who can now survive in Green Deal are those with legacy access to the old ECO funding. So not surprisingly, things really slowed. Fortunately, we got back into a growth period again. We had a new cashback regime from DEC in the spring that remedied the lack of ECO for the Green Deal providers and restarts growth. At this point though, many ECO players, many of the installers, are now reconsidering their cash flow, their business model, and not simply relying on a 100% subsidy model, and started coming towards us for finance. At the same time, we realised that we had to be more proactive. Now you've heard we can't speak to end customers, but we can go and speak to the installers. So we have a big outreach program. We've been out to about 50 companies. We help them with understanding the market, understanding customers, understanding marketing to an extent, but more particularly we help them with the finance contracts, the processes, how to be effectively an installer lender. And we were successful. In June 2013, we had 3 companies that could take our finance. At the end of the year, we had 36. June 2014, a year later, 54. So what impact did this have? Kickstart from DEC with a subsidy, a big outreach program from us, and gratifyingly, it did have an impact. We saw, these are weekly plan applications, we saw a 4 or 5-fold increase in the year. So from March 2014 to this year, we've seen applications rise from a little over 100 to over 500 a week. This is quite substantial. And our ongoing plan values now for our book have risen from 7 million to 42 million. So we're seeing applications coming in at a run rate of about 1.5 to 2 million a week, which is pretty substantial. And to put that into context, nearly half of our total demand has come in the past 5 months. So if you had a view of the Green Deal 6 months ago, you would not have the picture at all. Here's our picture. Startup, hiatus, a change, we do outreach. Government realises that blending with ECO is too difficult. Bring in subsidy programs. At that time they announced a 540 million programme over 3 years, of which 450 million is for the domestic sector. We then saw even stronger growth in the period from summer last year, with our outreach program really taking off, with companies becoming more experienced, knowing what works with customers in conversations in the home, knowing how to take the Green Deal assessment and unpick it and represent it back to customers as attractive packages which customers are prepared to finance. People don't like J-curves. We are now in towards J-curve territory, even stronger growth from the very short lull over the Christmas period. So this is quite astounding. And a lot of our criticisms were clearly in the earlier time. Remember, startups, take time to mature. This is the two-sided coin about subsidy and pays. And effectively, customers require incentives to act, to do something, to take out a plan, or to green their home. And the pays system, the pay-as-you-save system, mitigates the cost of carbon reduction. So, looking at our book, approximately for the 10,000 plans we ran these numbers, we see that customers are funding about 46% of the cost of the measures going into their homes against our loans. We are seeing that there's an incentive program coming from government or government regulations for a slightly smaller number, about 42%. And we can see that there are also customer contributions over and above. So these are against perceived benefits which will not be part of their paybacks. In other words, anything the customer contributes in that yellow is money that will not be paid back, is for other attributes. So from the aggregate now to the individual customer economics, and the first place to start really is customer inertia. Customers don't like high energy bills, they don't know what to do. More specifically, customers only don't like their bills when the bill lands on the doorstep. And after they've paid it, it's out of sight and out of mind again. Customers typically say, bill savings my business, carbon savings the government's business. So going back to that graph, they're not going to pay the red bit, they'll pay the Green Deal finance part. And what's in it for me is what any salesman has in front of them with a customer. What is the package? What is the proposition? And in this particular instance, it's specific measures for my specific home. The Green Deal assessment. You have an assessor in your home, you get a tailored plan for what you need to do in your home to reduce your energy bill and make your home more comfortable. It needs to be at the right price. Not only that, but it also needs to be within my budget. Customers only want to pay where they see a benefit. Many of these plans have long paybacks. Some of the items have such long paybacks that customers are not prepared to pay more than a portion of the cost. And if they can't pay for these measures upfront, what they want is the finance package. So that's so far so typical. The final point for us is, do they like Green Deal finance? And although Mark wasn't selling to you, enough customers now are saying yes to that final point, and I hope that you would too. So, what are they buying? Virtually all of our plans contain one or more of these three measures. The tiny proportion don't, so this is it. Condensing boilers, solid wall insulation, solar PV. And the golden rule restricts the lending sums to be proportionate to the expected energy savings. As Mark explained, what does that mean? It means we finance about a third of the cost. So the customer sat there understanding that they can have finance from us for a third. What's the next point? The next point is that these three measures have very different drivers. Customers want boilers, not for energy efficiency, they want boilers for hot water and heating. If the boiler's broken, they need a new one. It's a necessity. Solid wall is different. With solid wall, they're happy to have some reduction in their energy bills, which is about 30% of the cost, but they need subsidy to move forward. However, there is an element of home improvement, and to the extent customers see their homes are worth more or their homes are more comfortable, they'll contribute. And with solar, clearly there's a funding gap which is met by the feed-in tariff. There's a fourth driver, and that's direct regulation. So the first three are very much about the market and about customer wants and design of our package. The fourth one, regulation, what we see in front of us now of the landlord-tenant obligations 2016-2018. So 2016, a landlord should not unreasonably refuse a request from a tenant for a green build plan. 2018, a landlord may not let a property that doesn't meet energy efficiency standards. So those are the sorts of drivers around why customers are taking the plans. I'm going to look at a set now of slides looking at numeric examples of key energy efficiency measures. And across all these examples, all in the same format, around 4 of these, is a funding gap left for the customer to fill. So there's an amount of money that the customer is asked to pay upfront on the doorstep, which is very often a surprise because they expect everything to be financed. So looking at boilers in this example, we've seen the gap. So cost 2,500, with then 712. There's a gap of 1788 the customer has to pay, literally on the doorstep, by credit card, by cash, or with another finance loan. What we see with this though, and the point that this makes, is that you can take a standard measure and you can bundle to get towards a whole home concept. This is not a whole home concept, this is just a simple bundle. You can add controls to this, and by adding extra cost, in this instance the controls are £400, the energy efficiency of that boiler's function is so considerably enhanced that the annual saving now has risen to £187. We can lay in considerably more, and the customer's actually going to pay less on the doorstep for a bigger plan. So what this is saying is that you can bundle things smartly to help customers come to a conclusion that there is something in it for me. Solid wall. The point this slide makes is that if you have a fixed incentive, £4,000 from government per solid wall, it's pretty obviously going to drive the market that only small homes will get solid wall. So larger homes with typically larger energy consumption and with typically larger energy losses are unlikely to benefit from this. So in the north, in the Midlands, it's pretty good. In the south, not so good. Flipping across to PV, PV is interesting. The purpose of this slide is to show how 2 government incentives work together. So here we have the feed-in tariff and the Green Deal. And the customer has some choice around how they want to finance this. In this example, the PV, the solar photovoltaics, the panels on the roof cost £6,000, and the customer can pay that themselves if they have the money. They can take a loan, or they can find it in their bank balance behind the sofa. We can finance against energy savings. No, we can't finance against the fixed payments, the feed-in tariff payments, but we can finance against the energy savings quite a lot. So against £6,000, we can finance over £4,000, leaving the customer to pay a shade under £2,000 from their own sources. That's a pretty good deal. And in that instance, they're also getting the feed-in tariff, in this instance £574 a year, which, by the way, when the supplier pays them the £574 each year for 20 years, it's actually more than the cost of repaying the Green Deal, which would be £383. So that's not a bad plan. Or you can do rent-a-roof, which is the current dominant model. So rent-a-roof, customer says, I assign to you my feed-in tariff from my supplier. I've taken a present value of that at 6%. I said that's worth about £6,500. With rent-a-roof, you can therefore finance more than 100% of the cost. So now you've got 2 schemes working together, choice for the customer. Why this is interesting is because you can then piggyback on the existing feed-in tariff subsidy. So here's a mega deal, £17,000 whole home. Now it's not whole home in the way that we see in some of the very large schemes in Europe, but this is a pretty substantial plan. And in this plan, you can see that we will lend here about £6,500. The customer is faced with a shortfall of £10,500. Government chips in 4,000 for the solid wall element for this plan. EWI, by the way, is external wall insulation. The customer then is faced with paying £6,500 up front. That may sound a lot, but the present value of the feed-in tariff in this particular example is about 5,000. So effectively, piggybacking insulation and energy efficient measures on the back of a pre-existing feed-in tariff, which is already there, means that we can bring forward insulation measures. The customer sees a £17,000 plan and they pay £1,500. So this is an almost accidental, excellent example of how government policy can work. Solar PV was not a feature in our startup at all. When we began, solar PV was almost unknown. It only really came to the fore last year. And it only really came to the fore last year when the eco and subsidy monies fell away, because the installers were saying, what am I going to do? How am I going to pay my staff? How am I going to continue to sell? I know, PV. And when they did PV and there was some subsidy in the market, they can do these sorts of plans. So this is really quite an excellent example. Consumer profiles. Who do we actually lend to? What does it look like? Mark gave you the credit scores. What I'm going to do now is give you a quick pen portrait of what the customers actually look like. So here, you don't need to read this, here is a classic segmentation. So this is an Experian segmentation of customer types. The vertical line is the UK average. Right-hand side is where we overachieve. Left-hand side is where we underachieve compared to the UK norm. So we are over-proportionate to customers with low average income and little to some savings. And what do they look like? There are four, so you can see the four bars on the right-hand side which stick out. These are the homes and the people standing proudly in front of them, and they are young essentials, plenty of you in the room today. There are balancing budgets, probably plenty of you here in the room today. There are seasoned economy, plenty of people in the room today, this too, this is all good. Traditional thrift, probably not so many in the room today on traditional thrift. But these are the four segments where we overachieve against the UK norm. So what does the customer look like? Do they look like these people? What do their homes look like? And what we see here is that we are over-proportionate to mature homeowners, young renters, and budgeting families, as you might expect from those customer profiles. So again, we've got the standard profile. On the right-hand side, you can see some bars sticking out, overachieving. What do they look like? It's a bit small, but average income is the first bar. That's what we see here. So these are mature suburban owners. And then interestingly, the other three bars are those on restricted incomes. So these are mature homeowners with value homes. I think that's a bit like value range in the supermarket. Single people, private renting, and families with limited resources. So these are the sorts of homes that take finance plans from us. And you can buy commercially software to show you exactly where these people live or exactly where these homes are. So the coloured red are those areas which over-index against the loans that we are putting out. So you can prospect and you can map. And indeed, when we do map our providers, they do tend to actually follow where the red is brightest. So, some overall insight. The first and obvious point is that delivering home energy efficiency is not easy. It's a pretty simple thing to put down a ground solar array or to build an onshore wind farm. It is not easy to engage millions of customers. But the market's starting to get used to pace, and the delivery, as I call it here, customers saying yes, really depends an awful lot on the pattern of incentives. So the government incentives and how that works alongside pace is incredibly important. The second is, our green deal providers, nearly all of them, in fact all the active ones, are small to medium scale enterprises. They're all small companies. And we provide a vital source of working capital for these companies. We have 70 million now in trading limits with these companies. It's incredibly important to these companies. However, they are small, and inherently small companies have limited reach. For us to be viable in the way that was planned, we need to get to 100, 150,000 applications a year. We need more than SMEs to work with. We need to grow those SMEs, and we need more SMEs, and we need more Ms, medium scale. We need more big companies. We need even some big companies. And we provide a vital service to customers. Mark's already talked about widespread availability, and just to reinforce the point, the 20% we don't lend to is pretty much covered by eco. The people above the eco level who get subsidy, but below the 800 score who get a decent enough rate from the bank, that's 30% of the population. That's 8 million homes. 8 million homes who are not poor enough for eco, but not wealthy enough to get a good rate from their bank. That's our sweet spot. Final slide.
Thank you, Taylor. I'll finish on the final slide, which is that I really believe that pay as you save is a policy that has really great promise, like all policies, when you actually put them into reality and you make them work. It's full of difficulties and complications, just like the railway project down the road. But there comes a time when people say, what on earth was the problem? Why was there a fuss? And I really do believe that despite the challenges we've had over the past 2 years, the same will hold true of pay as you save, of the Green Deal. That it'll prove a very conventional way of financing energy efficiency in the home. It is supported by each of the three main parties that's committed to pay as you save, and that's why I believe that in the course of time that we will achieve over a decade our founding mandate, as it were, of achieving 1 million Green Deal plans. I really do hold that out as a prospect. Thank you very much, and very much looking forward to taking questions.
Well, thank you, Mark and Peter. An absolutely fascinating presentation. And it's so refreshing to hear a really serious discussion about energy efficiency that doesn't talk about kind of low-hanging fruit and quick wins and all those kind of things, which we've all heard lots about, and all of us now know not to be the case, especially in the household sector. So, questions, please, to the Green Deal Finance Company. Yes, please introduce yourself and keep your contribution reasonably short, though we do like some comments. It's a conversation, not just a quick fire stuff.
Yeah, Graham Stevens, bluegreenuk.com. Would you agree that you have some 45 measures that you install? Would you agree that more measures you have, the more potential feasible viability? And where does the number of measures really hit to the highest feasibility? In other words, could you bring in all the other utilities?
Yeah, great question, because one of the things we want to encourage is innovation. And one of the things that is difficult with innovation is there are 45 measures. And if you want your measure to be considered, you have to put it forward, and that's quite a process. In fact, there are some people in the room who know very well what that process is. But the guys who write the standard assessment procedures will have to vet these new measures and take a view about their energy efficiency. We want to see some new technologies come in. I mean, interestingly, looking at micro CHP, so heat pumps, biomass boilers, and solar thermal, we've had about £600,000 of application across our book. Interestingly, because it is so complicated, that's only converted through to 250,000 of loans. So there's a bit of an issue there, but that's still encouraging. So there are interesting things that are happening. That said, the slide I showed, 99% of our plants, pretty much, have got condensing boiler, solar PV, or solid wall. And the other measures are there to fill in. We'd like to see the microgen piece come forward. We think there's a great potential there, particularly off-gas grid. There are 6 million homes off-gas grid. Today, that's been really a space for wealthier deciles. We think that there's a considerable number, millions, of low decile homes who have not been considered to date for off-gas grid heating, small CHP, small district heating. The government changed the rules on small-scale district heating quite recently for eco. So, we're very open. We'd like to see more of it, but don't expect very quick results because it takes time to learn how to pitch, how to package, and how to get customer acceptance for these technologies.
Thank you for that. Yes, lady.
What is fuel for micro-CHPs?
It depends what it is. So if it's biomass boilers, it's going to be wood chip. Wood chip isn't necessarily fantastically popular everywhere you look, but it has its fans. With heat pumps, it's electricity, and there's a coefficient which says that for every unit you put in electricity, you might get maybe 3 out. That would be quite nice. So there are also other machines which we have not been financing. So for example, you can have a gas engine. So again, you feed a unit of gas in, you get units of heat and units of electricity out, and you get more out than you put in. There are, again, even further away technologies we haven't financed. There are fuel cells. There are lots of interesting things coming through.
I just want to know for micro-CHP in non-gas areas.
It would be electric homes, which we would switch to heat pump. And unfortunately, our data doesn't show ground source heat pump against air source. They are radically different, but our database treats them just the same.
Yeah, I'm Neil Strachan from UCL. A blunt question. Why are your targets so modest? If you do your target of 100,000 homes a year, it'll take 250 years to retrofit the UK building stock. Don't you need to be doing an order of magnitude better than that?
We are a financing option, and with financing at our current rates, which is competitive but not a subsidised rate, it takes you into low or zero interest. We will only be an option for consumers, and therefore a subset of what the total ambition might be. And the expectations we've got there is to generate much more in the light of the experience rather than the initial forecasts that we inherited.
Which was 7 million homes by 2020, I see.
Well, yes, but that's the thing about forecasting. But of course, if you don't forecast things like that, you never get anything off the ground. But I joined after the forecasts and said I get the company financed and operational and see where we get to. And these are the kind of numbers that we're sort of looking at that we think are achievable.
Yes.
Do you see any flexibility in the near future about installation thickness? Because now you have for one installation 100 millimeter, but if you would go and take it further to a house or other standards?
I'm very happy to say that we are not competent to answer anything technical about the measures, so we have to rely on the entire apparatus, part of which is in this room, around the standard assessment procedures, so the SAP. It's the SAP measurements. There is an army of people who look at this. They are independent of government. They're certainly independent of us, but we don't really know who they are. So we have no view. We take a view about the performance of the measure because we're lending very long term. So we keep an open eye out, but we are not competent to answer.
Okay. Back there.
I just have a question on...
Do you want to introduce yourself?
Oh, sorry, Max Dunford from the Department of Energy and Climate Change. I was just wondering, do you know anything about the funding gap and what people are doing with that? Are they paying for the funding gap through savings, or if they're paying it through other loans, and kind of would that help explain why people are maybe not taking up the finance? And then also just another follow-up question. Labour is kind of suggesting that maybe they want to have lower 0 to really low interest rates. Do you think that would help Green Deal finance uptake?
Okay, on the funding gap, one of two things happen when we see a plan that we've quoted for not proceed. Either the customer has decided actually they're not interested in doing anything at all, and it falls away, or we see that the customer wants the measures but doesn't want our finance plan. And the usual answer there is that they have actually found the money behind the sofa. So the typical example we get is they asked around family and friends and came up with the money. It's less usual, but it still happens that you take a parallel private bank loan. So there are companies who will lend unsecured short-term 2 to 5 years to fill that gap, and that does happen, and indeed we've been trialling so that we can work with these banks to have associated top-up loans. So that's quite popular. We do hear of people paying on a credit card. That disappoints us. Yeah, so that financing gap, there's still plenty to play for with top-up loans coming alongside.
On your question on zero and subsidised interest, on the long-term plans, for that £3,500 average loan, for a long-term plan, you're probably paying the same amount in interest. So it follows that if the interest is set to zero, double the amount that can be financed out of a Green Deal plan. And that makes it a very powerful way of introducing subsidy into the system, not least because in subsidising the interest rate, you'll be subsidising it over 17, 20 years. And one of the problems with funding things up front is that it's unaffordable, and it's not subsidising over the time frame that you're realising the carbon benefits. Now, and also, because subsidies tend at the moment to be allocated to particular measures, if you had it allocated to the rate and increase the consumer power, that I'm a consumer now, I've got £100 savings, I can actually get double the amount. So I can use that purchasing power, if you like. They can then choose very astutely what particular energy saving measures they want, and I think that would be a very useful tool for driving innovation. So there are all sorts of attractions about zero or low interest. We haven't done any market research to actually establish what the impact would be on volumes. We're not really resourced to do that, that's not part of our mandate. But it is something that would be extremely interesting to look at, and instinctively you would think that if you are offering finance at 0%, you would be very much more competitive than anything else out there, and that would drive demand.
The gentleman there, and then we'll come to the front. Introduce yourself, please.
Yeah, this is Ram from UCL. Can you throw some more light on the rent roof scheme and what's there for the customer?
Yeah, so with Rent-A-Roof, you assign the feed-in tariff to your installer, so you get the free panels. The installer gets your money for 20 years. What you get is free electricity.
And what is the lease period?
Sorry?
You must be renting a roof for a certain period of time, right?
Yes, so effectively it's 20 years. So you're giving the money that your energy supplier will give to you. So typically, the example would be that you get £440 per year for 20 years from your energy supplier as the feed-in tariff. What you do is you assign the rights to that to your installer. Your installer takes that sum of money, capitalises that to fund your panels on your roof. However, they're not your panels, they're the Rent-A-Roof company's panels, but you get free electricity for as long as those panels are working. So the benefit to you is no upfront cost and free electricity. However, the question mark is, how does the householder understand whether assigning the feed-in tariff to the Rent-A-Roof installer is a good deal or a bad deal? So if I start talking to you about what discount rate you might apply to a 20-year stream of £440, and you flip out your 12 CHP calculator, you'd be a very unusual customer. So there is a question here about how transparent the Rent-A-Roof actually is. It's nice to say that Green Deal finance is completely transparent because it's always 6.96% and charges.
Hi, it's Nick Lomax from the Energy Saving Trust. I just wondered about the credit threshold and the 20% that can't get finance.
Yeah.
I guess I'm just trying to understand why you would need to credit that anyway, because ultimately people will have to pay their electricity bill. It's the responsibility of the electricity company to track those people down.
It's a good question. The Green Deal is sort of not reporting to two masters. The Green Deal was enshrined in the Energy Act, but has to be compliant with the Consumer Credit Act. And a lot of the complexity and difficulty we've had, having that the documentation that Petra was talking about that we prepared, is making sure that everything is compliant with the Consumer Credit Act at the same time as fitting in with the Green Deal. And it is very clear on the Consumer Credit Act, for very, very good reasons, that you must do responsible lending checks. And it's simply the case that people with a credit score below 620 would not satisfy a responsible lending check. And therefore, it's not appropriate for us to be lending to that part of the population. And that's where that comes from. But as Petra pointed out, most of that, a very, very large part of it will be covered by the eco arrangement, which is probably completely appropriate. But I'm talking generally speaking about the fuel pool.
And the customer profile of a person who will fail our credit check, they are either, they've had a county court judgment against them in the past 2 years, which is a bad thing, or they are currently in default of a bill payment. And typically it will be a mobile phone bill, or it will be a telephony bill, Sky bill, or mortgage repair, whatever it's going to be. So they're in default of a bill payment and or county court judgment. A responsible lending company, as Mark says, can't just take that on the chin.
But wouldn't the electricity company, maybe they go down a prepayment route, that kind of thing, so, and because it's linked to community, that person might move out in a couple of months, that kind of thing?
Well, it's just not something that, under the current way that, the current regime for selling consumer credit does not allow you to lend in those circumstances. I think that's sort of more or less the end of the story. And I'm not sure I want to change that. I think that's too radical a departure. Clearly, a household could get impoverished and may need to move to prepayment, and that's the risk we take. That's the risk that we take happens over the life of the plan.
And we can finance on prepayment meters. So as you very well know, Nick, having a prepayment meter does not necessarily mean you're in fuel poverty or disadvantage. So there are people who like prepayment meters for budgeting purposes, and we can and do put Green Deal plans onto prepayment meters, but they have passed our credit check.
Gentleman here.
Yeah, so Dan Action from Energy UK. It's just a question really about how you see the future and whether you think that a pay-as-you-save model or a different scheme in the able to pay market will actually be sort of self-sufficient in the long term and actually deliverable without some form of incentive or subsidy.
I think, looking as you know from the energy sector, that the state and the delivery of energy are very close to each other, and carbon reduction on top of that means that the state will never move away. And I think, generally speaking of energy efficiency, I don't really see a world where the state is not providing support one way or the other for energy efficiency. So I don't yet see that world coming, unless you take very high assumptions about the cost of energy and wholesale prices. I think talking about some of the original forecasts for the Green Deal did rest on really quite racy assumptions about energy costs and wholesale prices, but with the oil and gas prices halving or whatever, oil and coal prices halving, gas prices coming down by a quarter or whatever, I don't think that's going to happen for a very long time.
And one last one at the back there.
Mike Bell, UCL. I've kind of got many questions, so I'm trying to decide which one, but I think I'll go with so local authorities. To what extent are you working, or has there been interest from local authorities? Are you targeting them because they seem like such a great conduit to getting people to view?
Yeah, I mean, local authorities are very interesting for us from demand generation and also delivery agents, and there are some in the green, which is fantastic. As you know, there's 88 million assigned by DEC to the 21 local authorities who won funding to introduce green deals into the market. What we've seen from this, though, is a very, very slow start, and it's because of the inexperience of the sector in dealing with individual households making individual financing decisions. And it's not unnatural to expect local authority officials to be somewhat careful in recommending, for example, finance to householders. So what we've seen is that the local authorities are very good at area schemes. They're very good at social renters. They have not been very successful at private homes, owner-occupiers. They have not been very successful other than regulation on private rented. It's difficult to do rifle shooting. It's easy to do schemes. And the problem with the Green Deal, from their perspective, is that we are rifle shooting. We are looking at individual homes with tailored packages for their particular needs to their particular wallet. And this is a different way of thinking. So we've seen for that amount of money very, very small progress to date. We remain hopeful as effectively a rollout education program continues that we'll see more demand coming from that sector. But it's not the usual practice. Local authorities are predominantly focused on social housing, not so much in the space where we operate.
Well, thank you very much. I'm going to bring it to an end, except that I'm going to have the luxury of a question, because that's the chairman's prerogative, as you know. In fact, I'm going to ask one very simple question, which is, how do you account for the fact that you've got all these young renters in there? I mean, how are you getting over the landlord-tenant issue with regard to those guys? And the other one, the other one is more difficult in the sense that this is anything but simple, this kind of stuff. And as a kind of policy academic, I'm always wondering whether the complexity of particularly energy policies, and we have an unbelievably complex energy policy landscape in this country, but not just this country, whether that is necessary or whether you can see a way to simplify it. And allied to that, I'm amazed that there are so many financially very literate people in normal homes who can take on this stuff and do those calculations and actually work their way through discount rates and APRs and the different packages that PETA put up there. I mean, I'm a PhD economist, and while I dare say I could understand that stuff, it's not straightforward. And so it's a question about simplicity. So landlord-tenant, and then, I mean, does it have to be as complicated as this? Is that just the name of the game?
Landlord-tenant, thereby hangs the tail. Well, not only did we have to deal with the Energy Act and the Consumer Credit Act in an unholy alliance, but there was a sort of a third person at the wedding, which was the property law. And for very good reason, DEC in formulating the policy was clear that the debtor should be the bill payer, because the debtor is the person that receives all the protections under the Consumer Credit Act. Unfortunately, in property law, if you put things into a building, insulation and so on, they become the property of the owner of the building, the landlord. And that created this conflict that it was actually the landlord in property law that was the debtor, whereas the intention was that the bill payer should be the debtor. And that took quite a long time to sort out. And we did sort it out. DEC agreed to make some changes to secondary legislation, which came into effect on the 28th of February last year. And now landlord-tenant plans account for about 7% of our book. What's interesting is that the figure should be 15%, because that is a proportion of private rented stock against the total. And so we're very much looking forward to that to develop. And my God, that was complicated getting that legislative muddle sorted out. But I regard all that complexity as backstage complexity. Really, the art is to convert all the issues and so on we've talked about into simple deals that consumers can understand, that are presented fairly, that treat the consumers fairly, that present the deals in a transparent way. And I think, what we have found in some of the research we did is that actually there was a surprising level of, well, I pay this and this is my return over 7 years. People get that in a much, if it's presented in a straightforward way. I think when you are doing some of the more complicated schemes, when people are sacrificing a return for the upfront cost in a way that they don't fully understand it. I think that's a dangerous area.
And I just add one thing, which is new technology. So thank God, tablets, iPads, or other makers. That is an absolute boon, because it means that you can hide tremendous amounts of complexity into very simple graphics on your handheld tablet in the customer's home. Run through scenarios, run through changes, run through little video clips of what it's all about. So that technology actually has been a fantastic boon for us. All the assessors, all the providers use these handheld tablets with the software on. All the algorithms are all hidden away in the background. And what matters then are your processes and your training, rather than actually trying to get to grips with complex concepts.
Well, thank you very much indeed.